The banking crisis here in the United States continues as First Republic Bank was the third major bank here in the United States to collapse after Silicon Valley Bank and Signature Bank. Now, First Republic Bank was the largest bank to collapse so far in 2023, making it the largest bank failure since the 2008 crash. And the reason why we've been seeing these bank failures has to do with the interest rate hikes that the Federal Reserve Bank has been doing, because we have been seeing the most aggressive interest rate hiking by the Federal Reserve Bank since the early 1980s. And back then, the Federal Reserve Bank had to jack up interest rates so high to the point where mortgage rates were almost at 20%. It was about 18% mortgage rates because of how high inflation got, and they were facing stagflation, meaning high inflation and a slowing economy. And that's the fear that we have here in the United States. Are we going to see stagflation where inflation stays high while the economy starts to slow down? And if you kind of look back at what the Federal Reserve Bank has been saying throughout the last few years, it's interesting to kind of see the trend of how our economy and inflation has progressed. Because in 2020, the Federal Reserve Bank said that there is no inflation, there's nothing that you need to worry about. Then came mid-2021 when we saw 4% inflation, when the Federal Reserve Bank and the government said that inflation is transitory. Then by November of 2021, we saw around 7% inflation, and that was when the Fed said that inflation is not transitory. Then came January 2022, and that was when the Federal Reserve Bank said that we need to fight inflation. It's a serious problem, but not yet. We'll start fighting it in the future. Then by March of 2022, that was when we saw the first Federal Reserve Bank interest rate hike at 0.25%. By the mid part of 2022, we were seeing multiple 0.75% interest rate hikes because of how high inflation was. By October of 2022, that was when we started to hear more worries publicly about an economic slowdown, but the Fed kept saying there's no possibilities of a recession, and the worst case scenario is that we would see a soft landing. And then by April of 2023, that was when the Federal Reserve Bank said that inflation is too high. We saw two big banks collapse, and the Federal Reserve Bank came out and said that now a recession is the new base case scenario. And to kind of put the interest rate levels that we're seeing right now in perspective, back before the 2008 crash, interest rates hit 5.25%, and that was the highest that they went, and then the economy ultimately crashed in 2008. That's where we are right now in terms of interest rates. Back before the 2000 dot-com bubble bursting and the economic crash, back then interest rates hit around 6.5% before they ultimately crashed. Now, I want to make sure this is explicitly clear because there's a lot of misunderstanding about why the Federal Reserve Bank is raising interest rates, because you hear the Federal Reserve Bank saying that now a recession is very possible and very probable, and this is where a lot of people assume that the Fed wants to raise interest rates to cause a recession, when in reality, a recession is more of a byproduct of the higher interest rates. Because what the Federal Reserve Bank is trying to do is they're trying to do the opposite of what caused the inflation problem. What caused the inflation problem? Well, it was a lot of money printing. And this money printing didn't just happen in 2020 and 2021. It also happened before those years. But in the last few years particularly, we saw a huge influx of money into our economic system. What does that mean? So the Federal Reserve Bank worked with the government to print trillions of dollars. They injected this into the economy, and then people and businesses had access to a lot of money. Some of this money was in the form of stimulus checks. Some of this money was in the form of unemployment checks. Some of this money was in the form of business bailouts. Some of this money was in the form of corporate loans. Some of this money was in the form of other loans to people and businesses. So now there was all this excess money out in the system. Now, when you have all this excess money in the system, well, it created a flood, an increase in supply of money, which created much more demand. Because when you have all this money out there, people have the ability to spend. People are going to want to spend. The problem was nothing was being produced. So you had such high supply of money, meaning high demand from people. People had the ability to spend. People wanted to buy things, but nothing was being produced. Remember, this was the pandemic. Factories were shut down. Stores were shut down. Things were shut down. So nothing's being produced. People wanted to spend. So now these people that wanted to spend started buying things when there's not that much being produced. And this then caused the price of things to go up. This is what inflation is. Now the Federal Reserve Bank wants to reverse that. And the way that they want to reverse that is they want to now cool this demand. Because back then we had such high demand, which caused the prices of things to rise. Now, in order to bring inflation down, the Federal Reserve Bank wants to cool down the demand, and the way that you cool demand is by getting rid of that money. And the way that the Federal Reserve Bank can get rid of this money is by raising interest rates. And that's why we've been seeing such an aggressive move by the Federal Reserve Bank to raise interest rates, not to cause a recession necessarily, it's to cool down the inflation problem. Now, the byproduct of cooling down inflation is, well, you see economic pain. Because now when you remove money out of the economic system, that means people have less spending ability. Because if there's less dollars floating around, if interest rates are higher, that means less people are getting loans. And that doesn't just mean getting a mortgage. That means less businesses are borrowing money. That means less people are borrowing money. That means the government should be borrowing less money. There's less money floating around, less dollars entering our economic system. And so if there's less dollars entering, that means there's less spending happening. And if there's less spending happening, that means businesses make less money. If businesses make less money, that means they have smaller profits. If businesses have smaller profits, that means they're not going to be investing in more growth. They're not going to be able to hire more employees. In fact, they might have to downsize. They might need to shrink. They might need to lay some people off. They might need to cut some divisions. They might need to completely shut down. And this is that slowdown and that shift in the economy that we're seeing right now. And this is where a lot of people have questions as to what's coming next. The Federal Reserve Bank has been so aggressive to raise interest rates. We've now seen 3 big banks collapse. And now the question is, what's coming next and how much more pain will there be in our economic system? Just take a look at Bed Bath & Beyond, for example. Why did Bed Bath & Beyond fail? Well, there's a lot of reasons why, but ultimately it comes down to there's not enough demand for the Bed Bath & Beyond products because people stopped shopping at Bed Bath & Beyond and instead they went to Amazon. And yeah, we can look at other things like there was bad cash flow management. They spent a lot of money, $625 million on stock buybacks when they could have used that money to invest in their e-commerce store. They could have done a lot of things differently. But ultimately, if people kept shopping at Bed Bath & Beyond, they would have still been alive. But because the demand for Bed Bath & Beyond products fell, they didn't have the ability to continue running their operations the way that they were, and they weren't able to find a solution, so they ultimately failed. This is what happens when demand falls. You see profits go down, you see revenues go down, and sometimes you will see businesses fail. And along the way, that could also mean layoffs, that could also mean divisions getting cut. And this is that plan that the Federal Reserve Bank has, where right now they are working to raise interest rates to do one thing: cool down inflation. And if you don't get inflation down, you're going to have much bigger economic problems in the future. That's why it is so important that the Federal Reserve Bank has to get inflation down, because inflation, fighting an inflation problem is more difficult and more significant than fighting a recession. We know how to get out of a recession. We've been in a recession pretty much every decade for the last century. Recessions happen. It's a part of our economic system. And the reason why recessions become so much bigger and so much worse is because we try to desensitize ourselves from risk. When we try to avoid the idea of having economic pain, when we try to create stimulus programs and more economic stimulus to avoid a recession, that just makes the bubble bigger. And now here we are today, where we're facing what a lot of people call the everything bubble, because over the last number of years, we have seen the valuations of assets across the board skyrocket. And then now the Federal Reserve Bank has to now prick the bubble, and they have to bring inflation down. Yes, this means more economic pain. Earlier this year in 2023, Senator Elizabeth Warren grilled Jerome Powell. And the reason why it was interesting was because Jerome Powell, in their annual report, the Federal Reserve Bank's annual report, said that they expect unemployment levels to go up to the mid 4.5% by the end of 2023. And what that means when you have 3.5% unemployment rates, which is kind of where we are right now, is that about 2 million Americans are going to have to lose their jobs in order to see 4.5% unemployment. And she was saying, how do you feel knowing that 2 million Americans are going to lose their job? Now, again, the job losses are a byproduct of the bad financial planning processes that we had previously. This is now, how do you fix the problem? Well, you have to do the opposite of what caused the problem. And that means, yes, you got to pull money out of the economic system. Yes, that is painful. And that's difficult because we're in an environment and society where nobody wants to feel pain. Nobody wants to go through a downturn. But the reality is recessions are like a refresh to our economic system. It is a way for our economy to restart, for the dumb investments to fail, for the bad businesses to fail. And that creates opportunities for the new business opportunities, the new investments to thrive, and the smarter investors to thrive. Because if you live in an environment where nobody loses, where no business loses, and there's so much free money everywhere, you build a big bubble. And then when you keep trying to propagate that same system, the bubble keeps getting bigger. And yeah, you can keep inflating a bubble, but eventually the bubble's going to have to burst. And the bigger the bubble is, the bigger the burst. And this is where now understanding that while you have a lot of people saying there's not going to be that much pain, there might just be a soft landing, it's going to be a mild recession, just understand that there's still a lot of issues in our economy right now. And I'm going to talk more about these in this video because I really want to talk about valuations and how valuations have changed over the last few years, particularly with startups and real estate and other asset classes. And then I want to talk about the economy and where we're going. So this is where now understanding what's happening, preparing yourself, and understanding no matter what happens, whether it's good or bad, you want to make sure that you're prepared and financially educated. That way you can capitalize on whatever's going to come your way. And this is where it pays to stay up to date on what's happening. And that's why I created Market Briefs, which is my free financial newsletter, which is why if you have not joined Market Briefs yet, I highly recommend you do so. It's a free and simple way for you to stay up to date on what's happening in the top financial news, with things like the banking sector, the housing market, the stock market, the economy, and everything in between. It's a completely free newsletter. You can read it in less than 5 minutes every morning. And I got the link to how you can read Market Briefs down in the description below. We are facing a valuation shock across multiple different asset classes. Back in 2019, our economy was already slowing, and there were worries that we were going to enter a recession. Why were there worries of us entering a recession? Because of the slowing economy. But that was when in 2019, the Federal Reserve Bank started cutting interest rates to start stimulating an already okay economy to prevent economic pain. We weren't already in a recession, but we were seeing the economy slow down. And to prevent us entering a recession, to prevent that pain, that was where the Federal Reserve Bank back in 2019 started cutting interest rates to stimulate the economy. And this then caused the valuations of assets to rise. And this was assets like stocks and startups and real estate. All different types of assets started to rise because now when interest rates go down, people can access more money, which means more people can get more money to buy things. When demand goes up, well, that can push the prices of things up. And then came the year 2020 when the pandemic hit and interest rates were cut to their lowest levels ever, not to mention the fact that there were trillions, not billions, but trillions of dollars worth of stimulus, quantitative easing, and loans created to help stimulate the economy. You could think of it like this. You wanted to go out and buy a $500,000 home. Now, if you were the only person making an offer to buy the $500,000 home, you might be able to get it for $500,000, maybe even $475,000. But if you make an offer to buy that $500,000 home, and in the first 24 hours of the home being listed, there's 40 other people making offers on the home, well, that home might sell for $600,000 instead of $500,000. And that's exactly what we saw happen after the pandemic because interest rates were so low and people could access more money. But this wasn't just occurring in the housing sector. It was happening in asset class after asset class, which is what people called it the everything bubble. On one hand, we saw startup valuations skyrocket as all these dollars chased the limited amount of companies that were out there. We saw stock prices skyrocket because investors needed a place to put their money. And of course, we saw the same thing happen in the housing market. We all remember how fast home prices were shooting up in 2020 and 2021 because everybody wanted to go out and buy a home. Everybody wanted to access the cheap debt, but there was a low inventory of homes available for sale, which caused home prices to shoot up. Now, at that time in 2021, even into 2022, it seemed like nothing bad could happen because everything was booming. The prices of everything was rising. Money was easy to access. Profits were booming, and it seemed like nothing bad could happen, but nothing can go up forever. And then towards the end of 2022, that was when the concerns started coming out about the inflation problem. And then in 2023, that was when the tide really started to go out. We started to see interest rates start to go up in 2022, but the effects of that started to be seen towards the end of 2022 into 2023. And now here we are in the middle part of 2023, and now people are starting to get worried about the effects of the higher interest rates to bring inflation down. And this is where if you just blindly follow what everybody else does, if you blindly listen to what everybody else does, you're going to be blind to what's actually happening. And this is where understanding rising interest rates cause economic pain. Why? Because it makes borrowing money more expensive. What does that do? It hurts spending. Our economic system runs on spending. The more money you spend, the more money somebody else makes. And so now when we were in an economy that was fueled by easy spending, easy access to money, easy just free-flowing credit, and now you take that away, there's going to be a shift. all the excess hot air is going to come out. And it takes time for it to come out. I mean, the Federal Reserve Bank is still trying to figure out how much more they want to raise interest rates, where they're going to raise interest rates to, what's going to happen with inflation. But we're starting to see some of the hot air come out. We saw it happen with some of the big banks here in the United States. But this is going to affect many different industries, not just banks. It's going to hurt many other corporations because corporations have borrowed billions of dollars over the last number of years because interest rates were so cheap. We've seen it happen especially in the corporate real estate market because there's a big shakeup in the real estate sector after office real estate has gone vacant and corporate real estate debt isn't all 30-year fixed rate mortgages. We also have a lot of consumer debt, which is skyrocketing, credit card debts, which are hitting new record highs, which are also variable interest rate debts. And we also have the highest level of national debt ever. All these things are going to cause some sort of consequences. And this is where now the question is, what is going to happen with interest rates? Because that's going to affect valuations. Like in the startup space particularly, and I think the startup space is interesting because we were starting to see a slowdown in the startup space in 2019 because of the slowdown in the economy. But then when the Fed started cutting interest rates, all of a sudden you saw this fresh new inflow of capital because now venture capital firms, banks, and these investment institutions were able to access a lot of money for very cheap. And when you can borrow money for very cheap, you don't need the best return. You just have to be able to beat the interest rate that you have to pay. And so now, if you can borrow money, say, for 3%, you only really need an 8% return on your money to justify investing your money. Where are these investments? Well, startups particularly. And same thing in 2020, when interest rates fell to the lowest levels ever. Now, institutions, banks, and venture capital funds were getting money hand over fist, and they needed a place to put their money. And where was this money going? It was going into startups, particularly in the tech industry. And we saw this massive boom in tech companies and startup companies. It wasn't just tech, but a lot of them were tech. And so now these companies were able to raise money at insane valuations. And I can tell you this from experience because as somebody here on YouTube, I saw it from two different folds. Number one, I invest in companies. And so I was able to see the valuations of companies that just didn't make sense. There was companies, I remember one reached out to me. They had, I think it was 10,000 email subscribers, or maybe it was less than 10,000 email subscribers. And they were claiming that because they have about 10,000 people signed up to their email list, they have a multi-million-dollar valuation on the company, which was really interesting because if you go out and run some Facebook ads, you can get 10,000 email subscribers for $40,000, $50,000. So it was an interesting thing to see. And they were valuing themselves at multi-million dollars. And it wasn't just that they were valuing themselves, they were getting these valuations from other investment firms, meaning investment firms were throwing money at them with these types of valuations. Plus, on the advertising side, here on YouTube and with Briefs Media, my newsletter company, there was a lot of companies spending big dollars on advertising. And they were willing to spend big dollars on advertising because they had big pockets. Investors wanted them to spend money on advertising. They wanted them to grow. And so it was great for creators because advertising dollars were through the roof. YouTube ad rates were skyrocketing. Now you're seeing the opposite, where businesses are saying, okay, we're not able to get that cheap money like we could before. Businesses that are not or were not profitable cannot get access to the same money because venture capital firms are saying, I can't borrow money at 3% anymore. I have to go out and borrow money at 7, 8, 9, 10% because they have to pay a premium to borrow money. I have to borrow money for higher rates, meaning if I'm going to invest my money into you, me as the venture capital firm, you as a startup, I need a better return from you. I need you to make a profit. And now a lot of startups are saying, profit? What do you mean profit? We're in our growth phase. We don't want to make a profit. We just want to gain market share, meaning we want to lose money. That way we can get bigger, faster, and maybe make a profit in 5 or 6 years. And so now there's a huge shift in that culture where now startups are being forced to try to figure out how to make a profit. Now, how do you make a profit? You got to make more money and you got to cut your costs. It's a little difficult to make more money when you're in a slowing economy. And we are factually now in a slowing economy because we got our most recent GDP data, which said that our economy grew by 1.1% when it was expected to grow by around 2%. So yes, our economy is slowing. And so now startups are having a tougher time trying to earn more money because, well, our economy is slowing. And then on the second end, it's by cutting costs. And this is why we've been seeing so many companies across the country now do layoffs. And this is from big companies to small companies, where we've been seeing more and more layoffs because companies are now having to figure out how they can stay in business without the help of venture capital firms, without the help of banks, without the help of institutions. And this is causing a huge shakeup in that startup culture. And along with that then comes valuations. Because when the money is easy to find, people are throwing money at you left and right, valuations also skyrocket. Why are valuations skyrocketing? Because everybody wants to own a piece of the company, right? Because when there's money that's free flowing out there, there's a lot of bids on these companies. Just like buying a home. If you have 40 bids to buy a $500,000 home, that home could sell for $600,000. If there's only one bid, it might sell for $475,000. And so what's been happening with things like startups is over the last number of years, valuations skyrocketed. And that was partially due to the fact that there was so much easy access to capital out there. With the easy access to capital, everybody was trying to throw their money at these startups, thinking that every startup was going to be the next Amazon or hopefully the next Google. And startups were seeing huge success. I mean, success at the time was raising money and hiring employees, and it was a great time because there was so much money free flowing. But now it's all coming together where inflation has happened. Inflation happened because we had all this excess money enter our economic system. So this inflation now happened, and inflation then affects the average person because when you have high inflation, you have to spend more money on your rent and your groceries and your car, and you have less money to go out and buy other things. And this is where the Federal Reserve Bank eventually said, all right, this inflation problem is definitely getting out of hand. We need to now slow this money process. We need to slow this money system. And the way they do that is by raising interest rates. Now, when you raise interest rates, the valuations start to fall because now you raise interest rates. Venture capital firms say, I can't keep throwing money at your startup that's losing money. And now hedge funds and institutions are saying the same thing. And so now the startups that were reliant on this easy capital can't get access to more money. And then you see the same thing happen. Again, this is not just startups, this is every asset class. You see the same thing happen in the stock market. Institutions, hedge funds, banks were borrowing money so cheap that way they could buy companies, do mergers and acquisitions, do stock buybacks. Well, when interest rates go up, it's much more difficult, meaning much more expensive to do so. And so now the chief financial officers are saying, maybe we shouldn't purchase this company right now at this price. Maybe if they give us a 50% discount, we'll consider buying it, but we can't do that right now. Maybe we shouldn't open that new store right now because we're not getting a return big enough to justify the billions of dollars of debt that we'll have to do. So this then causes a further slowdown in the economy, but going back to the valuations, that also means that valuations, things like stock prices also begin to fall because when valuations fall, well, that means the value of your stock portfolio gets hurt. That means the value of your startup portfolio gets hurt. And real estate has been one of those interesting sectors, from housing to commercial real estate, where on one hand, real estate is a lagging industry. Even when the 2008 crash happened, remember the 2008 crash started in the real estate sector and then trickled down into every other part of the economy. But the stock market ended up bottoming out around 2009, 2010. The real estate market didn't bottom out until 2012. And in 2012, the stock market was on the verge of breaking new record highs. So the real estate market is a lagging sector. And now what we're seeing happen is interest rates are rising and people are still buying homes. And it's creating a unique dilemma for the Federal Reserve Bank because now when they look at the inflation numbers, they're saying, okay, real estate is one of the biggest components in CPI, inflation. And in order to cool down inflation, they need home prices to not grow so significantly. If they want home prices to not grow so significantly, they need people to buy less homes. If they want people to buy less homes, that means you need higher interest rates. And you can start to see where the dilemma is. And this is something I feel like for the last 6 or 8 months, I've been saying this month after month, where the next Federal Reserve Bank is more crucial. And each month it keeps getting more and more crucial because we're seeing more and more of this balance between inflation and the economy. The Federal Reserve Bank is raising interest rates. And it's like a teeter-totter. On one hand, you have inflation. On the other hand, you have the economy. And the Fed is hoping, or has been hoping, that inflation will break before the economy, because higher interest rates bring inflation down. Higher interest rates also hurt the economy. The question that everybody's been sitting on the edge of their seats trying to figure out is, what is going to break first? Is it going to be inflation, or is it going to be the economy? And this is where now we're starting to see more pain in the economy. We're seeing it especially in the banking sector. We're seeing it in other parts of the economy too, startups and valuations. But overall, we still have low unemployment. The economy is still generally considered strong, but the economy is definitely showing much more red flags than there were 6 months ago or 9 months ago. While inflation, yes, it has come down off of its highs, but it's still extremely high. And this is where now the Federal Reserve Bank is hoping that these higher interest rates will cause inflation to go down without causing a lot more pain in the economy. So it's almost like this balance where hopefully inflation will break before the economy, but no one really knows what's going to happen. And if the Fed has to keep raising interest rates aggressively, well, that can cause more pain to the economy. And you can see now where the potential dilemma lies. If they break the economy first and inflation is not fixed, then what do you do? Because if the Federal Reserve Bank keeps raising interest rates, it puts the United States into a tough recession. You see millions of Americans lose their jobs. You see more bankruptcies happen. Then what's going to happen if inflation is still not down to their goal? Because you're going to see a lot of pressure by people in the government, by people to say, you need to stimulate the economy. You got to cut interest rates. You have to turn this thing around. You have to add more money into the economy. And sure, if you do that, that will stimulate the economy, will create more jobs, businesses will be able to invest more, and things can start growing and booming again. But what's going to happen to inflation? If you already have an inflation problem and then you start stimulating, that's going to make the inflation problem worse. And that's what makes now so unique, especially compared to previous recessions, because in 2020, 2008, and even 2000, and even previous recessions, going into the economic slowdown, there was no worries of inflation. I mean, there's always worries of inflation, but there was no actual high inflation problems. Before 2020, inflation wasn't something that people talked about or even really understood. Before 2008, inflation wasn't something that people talked about or understood. Before 2000, inflation wasn't something that people talked about or understood. But today, inflation is something that everybody knows, because inflation has been such a big problem in our economic system right now. It hurts the average consumer. And so now, when you have inflation that's already a problem and the economy is starting to get hurt, and if the Federal Reserve Bank has to keep raising interest rates, well, if they started to reverse and they started to stimulate the economy, sure, they can boost the economy, but then that's going to make the inflation problem worse. And then if you make the inflation problem worse, then what happens? Sure, you create a boost to the economy, but the dollar starts to get hit. The currency that we use to transact, the currency that all of our businesses use, the currency that represents the health of our economic system, then gets devalued. That's what inflation is. Inflation is the devaluation of our currency, because the buying power of each individual dollar goes down, causing the price of things to go up. So inflation is literally our currency being devalued. And if that continues, then that creates even bigger concerns in our economic system, not just that our economy is slowing, but that our currency that we run our economic system with is being devalued. Now, of course, we have a lot of benefits here in the United States, being the world's leading superpower. We are the world's economic superpower. We are the world's strongest military presence. But all these things are happening, and this is where you want to pay attention to not just what the Federal Reserve Bank does, but to inflation and to the economy and to what's going on with interest rates. Because all of these things are coming together now, and as we see more and more pain in our economic system with things like First Republic Bank, with things like the Bed Bath & Beyond, things like more layoffs happening, it's going to put more pressure on the Federal Reserve Bank in the coming months as to what they're going to do. And if the Federal Reserve Bank stays true to their word to bring inflation down, then that could mean that the economy could break first, and that's going to impact a lot of people. Now, again, recessions, while they suck, are a part of our economic system. They have happened pretty much every decade for the last century, and they will continue to happen. The problem is when you try to avoid recessions, you try to avoid the economic pain, the next recession, the next crash becomes even bigger, because now you didn't let the economy reset in the first place. And this is where, when you try to desensitize yourself to pain, you try to avoid any sort of the economic pain, you make the problem much bigger and the long-term pain even larger. And this is where now we're facing a tough situation where, yeah, it looks like we're going to be entering more economic pain while most people don't want to see it, or they're going to be blindsided by it. This is where understanding, no matter what happens, you want to be financially prepared. That way you can take care of yourself, your family, and your community. But in order for you to do that, you have to prepare when times are okay. That way you can have money put aside to protect yourself, but also have money put aside that way you can capitalize on other opportunities that might come your way. Let me read you this title from the Washington Post. It says, "Lower mortgage rates won't make buying homes more affordable." Now, you might hear that and say, what do you mean? If I could buy a home right now at a 3% mortgage, if I wanted to buy a $500,000 home, well, it's going to be much cheaper than if I had to pay 7% to borrow that $500,000. But this is where things are a little bit unique in our economic system right now, because when mortgage rates go down, you don't get to just buy the home for $500,000. Then you have to pay a premium to buy the home. Because what we've been seeing, and this has been happening throughout 2023, is anytime we see a little dip in mortgage rates, the same thing happens. Everybody wants to go out and buy a home. And so as soon as we see a little dip in mortgage rates, you then see everybody call up their mortgage banker and everybody calls up the realtor. They go look at the homes that are available for sale and everybody makes an offer on the homes that are out there. And now all of a sudden, you go from the slow housing market where no one's getting an offer to then all of a sudden, 10 offers on a home, and now you have to outbid each other to buy a home. And so we're seeing this like real volatile housing market where 1 month you're seeing a huge slowdown in the housing market, and then the next week when interest rates drop, everybody goes out and they start buying homes, and that pushes home prices higher. So we're facing a very unique dilemma where, yeah, the higher mortgage rates have slowed down the housing market on a general level. But then anytime we see a little drop in mortgage rates, we see a quick shift and turnaround in the housing market where people then want to go out and start buying homes again. And this is where now, what is going to come in the housing market? Well, it goes back to the Federal Reserve Bank. And I know I sound like a broken record at this point, but if the Federal Reserve Bank stays true to their word to bring inflation down, that means that they are going to continue raising interest rates. And it looks like they're going to have to continue raising interest rates if they want to bring inflation down. And that could go against a lot of people's opinions and wants and beliefs, because that's going to cause more pain in the economy. But if you want to bring inflation down, you're going to have to stay aggressive with interest rates. And so now the Federal Reserve Bank is working to raise interest rates to slow down demand. And one of the byproducts of that is, well, that's going to put higher pressure on mortgage rates. And as mortgage rates go up, well, that puts downward pressure on home prices. And so a lot of people are now wanting to buy a home. They're ready to buy a home, but they're unsure where home prices are going to go. And everybody has a prediction. Everybody has a guess. Just wait it out or buy it now before home prices go higher. The reality is it's going to ultimately come down to what the Federal Reserve Bank does. If they stay true with their word of wanting to bring inflation down, that means interest rates are going to continue going up, and interest rates are going to go higher than what people expect, which means it's going to continue to put higher pressure on mortgage rates. And if you continue to see higher pressure on mortgage rates, well, that makes borrowing money more expensive. Making borrowing money more expensive makes buying a home less affordable. That reduces demand for the housing market. On the flip side, if the Federal Reserve Bank says, okay, you know what, our economy is taking a nosedive, we're seeing a lot of layoffs, we're seeing unemployment go down, forget what's going on with inflation, we're now going to start cutting interest rates, well, then mortgage rates are going to fall too. And if mortgage rates fall, you bet that people are going to want to go out and take advantage of the lower mortgage rates, which means people are going to want to go out and buy homes, which means you'll see more bidding wars on homes, which would push home prices up. And you can start to see why that's a dilemma, because if the Fed starts cutting interest rates to stimulate the economy, well, home prices would go up. And if home prices go up, that would impact inflation. A third of our CPI, 33% of the CPI data is reflected on the housing market. So if home prices start to go up, where do you think CPI and inflation numbers are going to go up? That would impact our inflation numbers. And so if inflation starts to go up, well, the Fed was able to kind of put a Band-Aid on the economy problem, but then inflation becomes an even bigger problem. And this is that rock and a hard place that the Federal Reserve Bank is in. And when it comes to the housing market, this is where we're going to see a lot of shakeups. And real estate now is becoming much more sector by sector, because the housing market has been very strong the last number of years, but other industries haven't, like the office sector. That sector of the real estate market, commercial real estate market, hasn't been as strong as other sectors, and it's very localized. When people buy a home, they don't just buy a home based off of how much the price of the home is, they buy a home based off of what the mortgage will cost them. And we saw this in explicit detail over the last number of years, where people didn't really care about how much they had to pay for the home. They were willing to outbid homes by 6 figures as long as the mortgage rate made sense. So this is where now understanding what's going on in the real estate market isn't a one answer question, because you have the housing market, you have office real estate, you have the other commercial real estate, and then you have it differentiated by neighborhoods. And certain neighborhoods are getting hit in the office sector, while other neighborhoods are booming in the office sector. And so different cities across the country have completely different cultures when it comes to going into the office. And this is where we are going to see a shakeup. I mean, if you look into some of the bigger cities across the country, there's a lot of vacant office buildings, multi-story office buildings that are sitting there vacant. And the reason why that's important is because over the next couple of years, we're going to see about half, according to a lot of economists, about half of the total corporate real estate debt readjust. Because commercial real estate debt is not a 30-year fixed-rate mortgage. It readjusts every few years. And so now if we see about half of the commercial real estate debt readjusts, that means these people that are holding on to the office buildings, that are owning the office buildings, a big chunk of them are going to see their mortgage rates on their offices readjust. And if interest rates continue to stay high, that means now you could see your payments go up by 30 or 40, 50%, because nothing changed except your debt readjusted. And so now if you're not making enough money because your office building is vacant, your costs are going up by 20, 30, 40, 50%, that's going to put you in a tough situation. And many people might not be able to qualify for a refinance, because if your building is sitting vacant, the valuation of your building might fall. And if the valuation of your building might fall, you might not be able to refinance. And banks might not be willing to give you a loan, which means you might be forced to sell your building in the coming years. And if you're forced to sell your building, well, we could see an increase in supply, which could also impact the valuation of these buildings. And this is where now, when it comes to the housing market and the real estate market, understand that if there's one factor you want to pay attention to, this is the Federal Reserve Bank, because interest rates are going to play one of the biggest driving factors as to which direction the housing market and the broader real estate market is going to go. And you also want to pay attention to the economy, because if people don't have the ability to buy a new home because they're struggling to get a job or wages aren't keeping up, well, that's going to continue to impact the housing market and the overall real estate market. But right now, what's impacting the real estate market more than the economy is interest rates. But this is where you want to keep an eye on interest rates and the economy. That way you can keep a broader picture as to what's going on, not just in the housing market, but in every different aspect of our economy. Retirement used to be known as a three-legged stool, where one leg was your pension you got from your company, a second leg was the Social Security you got from the government, and the third leg was your own personal savings or your investments. Well, now what we're seeing happen is that pensions have become a thing of the past, because companies don't offer pensions anymore. Social